So today, we're going to talk about a guy who looked at the chaos of a casino and then looked at the chaos of the stock market, and he saw the exact same thing. A math problem, a problem that he knew he could solve. I mean, it's the dream, right? To have some kind of secret formula that lets you beat the house, that lets you outsmart the entire market. Well, for one guy, this wasn't just a fantasy. He actually built that formula. He proved it worked on the blackjack tables in Vegas, and then he turned it loose on Wall Street. Let's get into how he did it.
All right, so our story doesn't start with some high-rolling gambler in a fancy suit. Nope. It starts with a quiet math professor named Edward Thorp. And he wasn't looking for a lucky break. He was hunting for a mathematical certainty. Now, you gotta understand, Thorp's background was pure academia. We're talking a PhD in math, doing research at MIT alongside the legendary Claude Shannon, the literal father of information theory. This was not the resume of your typical gambler. This was the resume of someone who could see the code hidden behind all the noise. And that academic brain was his secret weapon. Then, in 1962, Thorp completely turned the gambling world upside down. He published this book, Beat the Dealer, and in it, he proved with cold, hard math that blackjack wasn't just a game of luck. He showed that by just keeping track of the cards that have already been played, you could figure out when the deck was hot, when the odds had actually flipped in your favor. This was a massive, massive shift in thinking. Before this book, everyone just assumed blackjack was all luck and gut feelings. After Thorp, it was a science. He proved that the old saying that the house always wins wasn't necessarily true. With the right strategy, you could actually flip the tables and get a real, measurable statistical advantage.
But, knowing you have an edge is one thing. That's only part one of the puzzle. The real challenge is knowing what to do with that edge. How much money do you bet? How do you actually turn that advantage into a fortune without going broke on one bad streak?
And this is really the million-dollar question, isn't it? If you bet too small, you're just leaving money on the table. You're not taking full advantage of your edge. But if you bet too big, even with the odds on your side, a little bit of bad luck could completely wipe you out. Thorp knew he didn't just need a system for winning hands, he needed a system for sizing his bets. So let's just be super clear about what a statistical edge really is. It doesn't mean you're guaranteed to win the next hand. Of course not. It just means that if you play thousands of hands, you are mathematically expected to end up ahead. For Thorp, when the card count told him the deck was full of high cards, he knew the math was finally on his side. To figure out the betting part, he found this kind of obscure formula from a guy at Bell Labs named John Kelly. And the Kelly Criterion, it's just a beautiful idea. It's a formula that tells you the exact fraction of your money you should bet to make it grow as fast as possible over the long run. It is the perfect mathematical balance between being aggressive and being safe. And, the idea behind it is actually surprisingly simple. Basically, your perfect bet size is just your advantage, your edge, divided by the odds you're getting. To put it in plain English, the bigger your edge in any given situation, the more you should risk. And if you have no edge, you bet nothing. It's that disciplined. It takes all the emotion right out of it.
So after he basically solved blackjack, Thorp looked around for an even bigger game to play. And he found it on Wall Street. He had a hunch that the exact same mathematical principles he used in the casino could work in the stock market.
Thorp basically saw the stock market as just a giant, really complicated casino. It was just a series of bets. But in this game, your edge wasn't a deck full of aces. No, it was finding mispriced stocks, assets that were likely to give you a better return than their risk level would suggest. But the goal was exactly the same. Use the Kelly Criterion to figure out how much to invest to maximize your growth over the long haul.
So did it work?
You could say that. Oh, yeah. Over about 30 years, Thorp's hedge fund, one of the first of its kind, made trades that totaled a mind-blowing $80 billion. He basically invented the idea of being a quant, these quantitative analysts who use computer models instead of gut feelings to find their edge.
And this quote from Thorp himself just nails his entire philosophy. He saw no real difference between a smart gambler and a smart investor. Sure, the words are different, but the core problem is the same. Find an edge, and then use math to manage your money and your risk.
Okay, but here's where the story gets really, really interesting. Because the Kelly Criterion has this dangerous dark side, and honestly, understanding this is probably the most important lesson in this entire story. It's such a tempting thought, right? It's human nature. If the formula tells you the bet for the best growth, why not just double it for even faster growth? It seems to make sense on the surface, but it is a catastrophic, ruinous mistake, and Thorp's math shows us exactly why. So this curve right here tells the whole story. Along the bottom, you have how much you're betting, and on the side, that's your long-term growth rate. And you can see as you bet more, your growth goes up and up until it hits that perfect sweet spot. That's the optimal Kelly bet. If you bet less, you're being too safe. But just look what happens when you bet more than that peak amount.
And this is the part that you have to let sink in. Once you go past that optimal point, your long-term growth doesn't just slow down. It doesn't just flatten out. It falls off a cliff. It goes negative. If you bet double what Kelly recommends, your expected growth drops all the way to zero. Bet any more than that, and you are on a mathematical highway to going broke. It proves that being too aggressive is way, way more dangerous than being too conservative.
And that insane volatility is exactly why most pros don't actually use the full Kelly formula. What they use instead is something called fractional Kelly. So they'll do the math to figure out the perfect bet, and then they'll deliberately only risk a piece of it, maybe half, maybe a quarter. Yeah, they're giving up some of that maximum potential growth, but what they get in return is a much smoother ride, and they massively reduce their chance of blowing up.
Thorp was a true pioneer. He was a quant before that was even a word. And the lessons from his story are, believe it or not, more relevant now than ever in our data-soaked world.
So what can we actually take away from this? What's the Thorp mindset for, say, 2026? Well, it really just boils down to 3 steps. Number 1, find your edge. Don't go with your gut. Use data. Use models. Number 2, size your bets systematically. Use a framework, like Kelly, to decide how much to risk. And number 3, and this is the most important one, manage your risk. Always remember that betting too much is the fastest way to lose the game entirely.
And this isn't just some quaint historical story. This 3-step process, edge, sizing, and risk management, it's the absolute bedrock of the entire multi-trillion-dollar quantitative finance industry today. Every algorithmic trading fund, every complex crypto strategy, they are all, in one way or another, standing on the shoulders of Ed Thorp. So that leaves us with one final question for you to think about. Thorp found his edge in the simple math of a deck of playing cards and in tiny inefficiencies in the market that no one else was seeing. In today's hyper-competitive world where everyone has data and algorithms, finding a unique edge is tougher than ever. But the principle hasn't changed a bit. Finding it and proving it with data is always step 1. So, what's yours?